My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I really enjoy this series. It's a great way that I get to interact with you. I love reading your emails. Like, I don't know what it is, but I get so much enjoyment. I wish that you could see the smile on my face when I read your emails. You know, when I hear how different people are viewing this topic, and some people are doing very well, some people are struggling, and sometimes I'm shocked by the amount of detail that people share with me. It just shows that either, I've made an impact on their life or their lives. And, it's just very, very humbled by all the kind words that I've read here, in my email from many of you. And over the last couple of weeks, we've gotten I want to say 2,000 new subscribers. A couple of my videos here have been blowing up, which have been pretty cool. There's a lot of new people that have subscribed to the channel. So welcome to everybody. I talk about dividend investing. I'm a dividend investor, but the reason why I invest for dividends, or I am investing in a dividend growth strategy, is to live off of the passive income or the cash flow from my portfolio. The reason why I'm sharing that is, if you look at my channel, this is all I talk about. I talk really just three topics that I share here on the channel. I talk about dividend growth investing, I have this Review My Pie series, and I talk about financial independence and retire early. So if that's something that's interesting to you, that is all I talk about on this channel. I don't talk about crypto or NFTs or whatever is hype and trending. I talk about what I'm interested in. And that's what I've been doing for almost the last 3 years. And that's what I'm going to continue to do. I'm a do-it-yourself investor, and everything that I share here on the channel is pretty much either self-taught, learned in books, blogs, videos, podcasts, experimenting, whatever you want to call it. But I love dividend investing and the freedom that it provides to just your normal person, right? And the flexibility that you can gain from investing into dividend stocks and ETFs. And and also to add, I'm a pretty big nerd and really weird. I don't know. But that's a little bit about me. My wife and I were both down here in Austin, Texas, and we've been here for about 4 years. We just had a little baby boy. But yeah, other than that, just from a personal note, things are going well. Still investing, dollar cost averaging into the portfolio. Still working my butt off at my day job. I'm going to be traveling up to Minneapolis here tomorrow. Going to be up there for work for a couple of days. Then I'm going to be flying back, have the weekend with the family. And that's what's going on my end. All right, so in the video, we're going to answer one subscriber portfolio from an 18-year-old here in Malaysia. The first portfolio is going to be from a 33-year-old here in the US. The second, a 23-year-old here in the US. And portfolio 3 is from a 43-year-old here in the US. That is a lot of threes, 33, 23, 33. Timestamps will be in the description below, as well as the portfolio links. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice, just merely for your entertainment. And I don't pre-review the portfolios before recording this video. So I'm looking at them for the very first time. I try to keep it as authentic as I possibly can. I hate scripting. I hate trying to pre-record stuff. I'm just really bad at it. I'd rather just run it through and mess up as I go. But yeah, if you are not familiar with where Malaysia is, I knew that Malaysia was down here in Asia. I knew that it was kind of by Thailand. But what I didn't know, maybe somebody that knows this, is this part of Malaysia? I know that this is obviously Malaysia because I can kind of read, not the best, but yeah. So over here, Malaysia, is this Malaysia? Somebody in the comments, please let me know. Does this belong to Malaysia? I'm not 100% sure what this is. You got Indonesia, all that fun stuff. But speaking of Thailand, I've actually been to Thailand. When I was living in Germany, I visited Bangkok, really, really big city. I took a flight. I believe we flew from Bangkok up to Chiang Rai. We stayed in Chiang Rai and we went to Chiang Mai. I personally, as a tourist, did not like Chiang Rai as much as Chiang Mai because I'm a spoiled American and it's just not as touristy. So if you're thinking about going to Thailand, Chiang Mai is much more, catered to tourists. But if you want the real experience of Thailand, Chiang Rai was interesting. We actually went to the corner here of, what is it? The Laos and the neighboring countries when it went on the border there. But what we also did, this was back, I can't even remember, I think it was like 2013. We flew down here with every other tourist on, in the world. We flew here to Koh Tao, and then we took a boat ride over to this island, and we went over here to this famous island. There it is. Koh Nang Yang. I'm slaughtering it. However you pronounce it. Went over here, exactly where this picture is being taken. I was there. I stood there. It was pretty cool. But yeah, that's my little geography lesson for today. Anything else? What else do we got? I don't think I've been to China. I haven't been to any other Asian country, if I'm not mistaken. I want to go to Japan, but I've never been. Went to China. We went to Hong Kong. We went to Guangzhou, I mean. We went to Shanghai. We went to Beijing, Xi'an. Saw the Terracotta Army. Went there. I believe that's where it is. Yeah, anyways, I'm getting sidetracked. But yeah, so speaking of the world is kind of a crazy place right now, right? I can't turn on the news without either seeing Meet Kevin, end of world thumbnails, or seeing something going on over here in this part of the world. Like anytime I turn on the news, like it's just negative. Like negativity and everything. The world is ending and everything is horrible. And so I thought to myself, you know what? The world isn't actually that bad. There's a lot of great things going on. And there's a lot of, sometimes it's just the small things that put a smile on our face. Kind of something, like this.
How much was it? How much was it?
They gave it to me.
So you're not going to tell me how much was it?
Okay, they gave it to me.
I don't believe you.
Why?
How are they going to give you something like that?
They gave it to me like, hey.
Oh my gosh, those little kittens. Now that we all got a smile on our face, I can only imagine, like I said, there was like 2,000 new people that just subscribed to the channel. I'm sure there's one or two people out there or dozens of people that are watching this and thinking to themselves, what the heck is this guy talking about? What is this? But full disclaimer, I'm kind of weird. So that's just kind of how I am. So, but yeah, so all right, let's take a look at the very first question here from Ethan. So Ethan writes, hi Jake, my name is Ethan. I'm 19 this year, but 18 current. He's turning 19, but he's 18 currently. Okay, he's from Malaysia and a huge fan of your content, and you're one of the big investing content creators who got me started into investing. Well, Ethan, that is so great, man. I really excited to hear that. Wasn't really sure where to start, asked a few people, did my own research, but I thought might as well ask one of my main people who got me into investing. Anyways, I have a few questions about my investing journey. Since this brokerage account, Interactive Brokers, is a joint one between me and my mom, 49, do you think dividend growth investing is a good way to go about investing? Should we, since we live in a third world country, I was thinking maybe it would be nice to be able to start off with covered call ETFs, like the ones you mentioned in your videos, to get monthly cash flow statements and reinvest the monthly dividends into growth ETFs like VTI, VOO, and SHD. Or would you recommend going for a more aggressive method of doing VOO, VTI, and VIG? Okay, that's the first question. Second one here. Next, wanted to ask for some advice as well from my content, from the content creator standpoint. Honestly, I was really inspired about making content by you, Josh O'Mayo, and Mark Tilbury, because I've always enjoyed entertaining people with content creation or making someone's day better. So I was thinking of starting my own investing channel to measure my growth from when I just started, but also to entertain people and teach them about how valuable investing is to our daily lives. Hence, do you have any tips or how I should go about this and start off as a content creator? Okay, that's a really good question. Lastly, I really want to thank you for teaching me through your videos and how important investing is in general, dividend or growth, etc. Hopefully we'll be able to reach the level of financial freedom one day. Pretty sure you already did, but I'm not there yet. But yeah, cheers. And if you respond, okay, all right, cool. So Ethan, first off, man, thank you so much for the kind words. You know, when I started this YouTube channel, I never thought that there'd be a guy in Malaysia watching my videos, right? That's the very first thing. That's the wonderful thing about the internet, is just it opens up an entirely different perspective into what's possible. That's the first thing I want to say. So first off, let me address kind of your first question here when it comes to investing into covered call ETFs to generate passive income to then invest into other investments. In general, this is not the best idea, mostly because of the tax inefficiency. So I don't know how the tax treatment is in Malaysia, but that's the very first thing that you have to understand is what is the tax treatment of the dividend from an ETF like, QYLD or JEPI or whatever, right? So that's the very first thing. In general, for anyone here in the US, I don't think that's a good idea. And the math just doesn't add up. If you're looking to live off of the dividend, if you're looking to gather the dividend from one of these covered call ETFs, because dividends are not free, right? They're either taxed or they come at the expense of the ETF or the company giving out the dividend. So that's really, really important. Dividends are not free. So there's always a give and a take. In my opinion, if you're 18, turning 19 this year, I would recommend, in my opinion, watch my last video in terms of the time horizon. In my opinion, if you're looking to live off of a dividend portfolio, there's so many things that you have to factor in. Are you going to buy and sell? Are you going to just slowly build up a portfolio over time and never sell? Usually what's helped me with this is think backwards, right? If you were to fast forward 10 years or 20 years, what ideal position do you want to be in? Do you want to have $1 million portfolio that you're going to then sell and then buy something else? Or do you want to have maybe, a $700,000 portfolio? I'm just making up these numbers, by the way, and then have that portfolio generate, $50,000 in dividends a year, right? That's the thing that you have to kind of, understand. And that's what's always helped me when I thought, okay, in 5 years, in 10 years, what is the circumstance that I want? What is the situation that I want to have or be in? And then work backwards. Okay, if I want to then never sell, then, working backwards and thinking, okay, I have a 5-year time horizon, a 10-year time horizon, and then building my portfolio that way. So I like the ETFs that you have here, VTO, VOO, SEHD. They're all really, really good. Me personally, if you're just starting out and you're unsure, I would go with a conservative growth. In my opinion, if you're just starting out and you don't fully know what your goal is, this is my opinion, and this is for everyone watching this, I would go conservative and I would stick with the S&P 500. Go with the S&P 500 as you're figuring things out. You can then always pivot and do something else, right? That's my personal opinion. And if you have to sell VOO in 5 years because you change your mind, so be it, right? That's fine. But you give yourself a lot more options if you go with a conservative growth like the S&P 500 or VTI, for example, because then you're not pigeonholing yourself with one investment and you're flexible. Okay, so that's the first thing. The second thing with the content creation here on YouTube, the thing about YouTube is a lot of YouTubers, they start a YouTube channel with the wrong mindset or with the wrong intention, right? A lot of YouTubers, a lot of people watch these other YouTubers that, have 1 million subscribers or whatever. They make $10,000 a month. They're like, hey, this is how much YouTube pay me. So a lot of people think that, okay, or a lot of people watch passive income videos. If you want to generate passive income, invest into dividends, invest into real estate, and start a YouTube channel. First off, creating videos on YouTube is not a passive investment. I do this every single week. This is like a second job for me, but I love it because I enjoy it. This is not passive. Every single Sunday, I'm on my butt in front of this microphone, just spitting at it, right? Well, I'm not Eminem. I'm talking into the microphone, right? And it's kind of like a job, but I really, really enjoy it. It does pay, but it's not really like a passive thing where you just set it and forget it. All right, so let me debunk that. When it comes to starting a YouTube channel, whether it be investing or you like kittens, right? You want to go take pictures and videos of kittens and upload them on YouTube, right? You have to understand what's your motivation behind why you're doing it. If you're doing it just to make money, believe me, there's other ways that are much easier to make money than creating a finance or a personal finance YouTube channel, all right? So that's the first thing. What I would recommend you do is if you're passionate about investing and you love talking about it, you love researching it, and you could see yourself doing this on a weekly basis for a long period of time, then yeah, go for it if you're passionate about it. But here's the thing the advice that I would give you with the YouTube channel. Never create a YouTube channel with the intention to make money if you're kind of a casual person that's looking to do something like this, because you'll quickly notice how difficult it is to keep up with it, right? The YouTube algorithm is not friendly to those that just, create a YouTube video once every couple weeks or whatever, right? Or if you create one every single day, right? It is definitely a grind. All right, so that's kind of my take there. And also, the last bit of advice that I could give you if you wanted to create a YouTube channel is find your niche. There's only a handful of personal finance YouTubers on YouTube that can talk about everything, right? From crypto to NFTs to real estate and still get monthly views or weekly views. So find your niche, find something that you enjoy, and do it with the right mindset and with the right, the right attitude. And I believe that's how your normal person can succeed at becoming a content creator here on YouTube, especially when it comes to the personal finance world here on YouTube. All right, cool. Well, hey, Ethan, thank you so much for the kind words. Thank you for the question. I hope that that's helpful. And yeah. All right, the first portfolio here is from Evan. Good morning. My name is Evan. I'm 33 years old and just recently, within the last 2 to 4 years, got into investing. After trying out a few brokerages, I consolidated all of my accounts with M1. I have a taxable and a Roth with them. I love your opinion and your thoughts, what your thoughts are with my portfolio. I appreciate your videos and have learned a ton. Well, Ethan, thank you so much, man. I appreciate the kind words. I was in a similar situation. I used to be on, E-Trade, TD Ameritrade, not Fidelity, that was my 401k, and Vanguard. And I just consolidated all into M1 Finance as well. And, but yeah, I don't really know what your time horizon is or your goals. So I'm going to have to make a few assumptions when I'm looking over your portfolio. All right, let's take a look at your taxable portfolio here first. So your portfolio is up 168% and you have a really good dividend yield. You are beating the S&P 500. Wow, this is really good. And you have a very low expense ratio. In order to get this type of performance and to have such a strong dividend yield, you probably have something like NVIDIA or Tesla or something in here that's massive hyper growth, because this mix of a 3% dividend yield and 168% long-term performance, this is not easy to achieve. So, and you can see here the volatility in this portfolio. Let's take a look at what you have in here. So I knew it. I promise I did not look at the portfolio. I knew there was going to be some kind of NVIDIA or hyper growth in here. You got Tesla in here? You did not have Tesla. All right, one of two. Okay, so you got the Vanguard S&P 500, VOO, you got Walgreens, you got SPHD, you got Realty Income, Qualcomm. Qualcomm's been exploding. NVIDIA, Coca-Cola, AT&T, Microsoft, Apple, AGNC, VXUS, BND, Square, Target, PayPal, and 3M. Okay, there's some things that I really like. There's some things that I would kind of make sure, caution you or make sure that you understand, why. Like make sure that you're asking the right questions, right? So S&P 500, absolutely fine. Walgreens, yeah, sure, whatever. SPHT, it's a good monthly dividend ETF. It has a decent expense ratio, it's fine. Realty Income, it's okay. The thing with Realty Income is this is a REIT, so you're not getting favorable tax treatment. So depending on when you plan on living off of the dividend income, you already have a Roth as well. It may make sense to put this in a Roth, it may not. So if you're in a high tax bracket, you're going to be paying ordinary income tax rates instead of qualified, right? So VOO, you're getting good tax treatment, Coca-Cola, good tax treatment, but here with Realty Income, you're not. And I believe SPHD does have a few REITs, so you're going to get taxed, you're going to have some ordinary income in there as well, I believe. I'm not 100% sure, so don't quote me, but I think there's some REITs in here as well. Yeah, so with these other ones, right, like NVIDIA, Square, I think these are both PayPal, really great, high quality growth companies. But you have to understand, like 3M and PayPal, they're complete opposites, right? Like this is a quality value, high dividend growing company. It's a dividend king. and PayPal is a growth company. So very, very different. BND, yeah, I like that you have it at a lower percentage. I personally don't hold bonds, but because you have it in there, I like it at a lower rate. I do not like AGNC. AGNC is a mortgage REIT. Mortgage REITs, they're just a little bit riskier. You know, like when it comes to, you know, when you have market turbulence or market volatility, and with interest rates and the Fed, AGNC generally gets destroyed, as you can see, right? Like the S&P is at all-time highs, and this is down, what, over the last, let's say, year to date, it's down 20%, right? So this is something that I'm not the biggest fan of with AGNC. Yes, it pays a monthly dividend, but didn't they cut their dividend? Yeah, see what? Look at that. You see 16 and then 12. So these mortgage REITs, they tend to cut their dividend a bit more, and they're more sensitive to interest rates. That's why I'm not the biggest fan of these. I like Realty Income significantly more than AGNC because it's a dividend growing. It grows its dividend, and you know, it's a lot more stable in my opinion. So I like this portfolio. There's some names in here. You know, you personally, this is a hybrid approach to, you know, dividend investing, right? You have some legacy dividend companies in here, but you also have some growth companies in here, and there's a balance. So I guess the one thing that I would say here for you or for anyone, you know, you probably have a plan with these individual companies, right? There's a reason why NVIDIA and PayPal are in here, because you have a plan on, maybe you plan on, you know, selling out of them in a couple of years and then reinvesting them into, for example, Coca-Cola, right? Which is paying a higher dividend. So this approach can work. It's definitely not going to be the approach for everyone, but it definitely can work. Let's take a look at your Roth IRA. Your Roth IRA is up 44%. And 6 holdings, 2.3 dividend yield. This is not that great. I would hope, like, you're 33 years old, you got over 25 years before you're going to access this portfolio. You might want to skew this a little bit more towards growth. But let's take a look. So you got VTI, VNQ. VTI is good. VNQ is good. VWO. Okay. You have emerging bonds. Okay. You got bonds, more bonds, corporate bonds. Okay. So you have, this is kind of like the Dave Ramsey of Roth IRAs, right? You have a little bit of mixture of everything. You got your bonds, you got your growth, although you don't have like a growth, but you have your international, you have your bonds, and you have your US total stock market. Okay, so in my opinion, you got 25 years. In my opinion, I'm not going to tell you what you should do, but let me share with you what I'm doing. I have a 20, because you're 33, I'm turning 36 here in a couple of months, but I'm 35, and I have a 25-year time horizon. I have VTI at I believe the exact same weighting, but I have more growth. I have VNQ in here at I think 10%. I have VXUS at 10%, which is international. I have 0 bonds, but that's just my opinion and how I do it. But I have a large percentage into growth, VGT. That's my favorite growth ETF. It's from Vanguard. It's the Vanguard Information Technology Growth ETF. So that's something that I would check out. You're going to get a lower dividend yield. Like, say, for example, you lower the bonds, or you do whatever with the bonds. You take them out or you lower them. You maybe lower your exposure to international, maybe, if you wanted. Because I think you have 22 in international. If you lower those and you add an ETF like VGT, you're going to get a lower starting dividend yield, but you're going to get a significantly higher total return, and that total return is going to compound and compound faster over time. So I hope that that's helpful. In my opinion, if you got 25 plus years, you should, in my opinion, go for a little bit more aggressive. So I would tweak this so that you're getting a little bit of a higher compounding annual growth rate of the total return, right? A higher CAGR for the whole portfolio. And the way that you can get that, in my opinion, is adding an ETF, like a growth ETF like VGT as an example. But yeah, thank you so much for sending over your portfolio. All right, let's take a look at the second portfolio. He writes here, hey Jake, my name is Dominic. I'm 23-year-old dividend investor from Arizona. I started watching your videos in December 21, which kickstarted my interest in dividend investing. I tried my hand at day trading, but it was just something that I couldn't get into and lost money. Your videos really changed how I view investing and even got some of my family to watch your videos. As far as my portfolio goes, I started it in January and have been making deposits from budgeting with my paycheck and any extra money I have. I'm not sure of my time horizon, but I figured starting early is better than not starting at all. I have a 401k from my job and a small Roth IRA. Here's my taxable brokerage account. Any input is greatly appreciated. Well, Dominic, thank you so much, man. I appreciate the kind words. It's exciting. You know, if you're sharing my videos with your family, that means that you personally got, value out of the videos and you enjoy them. And that really puts a smile on my face. So Dominic, thank you so much, man. You're actually not far away. You're up in Arizona. I'm down here in Texas. And I've actually considered relocating and adding to the traffic in Arizona, relocating to Arizona here in early retirement. I got my eyes on Flagstaff and the areas up there. I'm really, really curious about that area. But yeah, so it looks like you have a 401k, you have a Roth IRA. It sounds like you're financially literate. Right? You're 23 years old. You're already thinking about investing. You've already learned that day trading is not for you. And that's a good thing, right? I think, even though you had to maybe learn the hard way and you touched the hot stove, you got burned, talking about with day trading, you got burned and now you learned from it. And isn't it so great that you got to learn that lesson, let's just call it a lesson, at 23 years old instead of 43 or 53? So 23 is still a really, really great age to start investing, and you're off to a great start. All right, let's take a look at your portfolio. So once again, this is in a taxable account. You're up 42%. You probably have some covered call ETFs or an IPO because it only goes to May 2020. You have a very high dividend yield. Wow, a very high dividend yield, and you have a decent expense ratio. So you have a lot of companies in here. You have 54 holdings. This is probably on the higher end. What you'll notice over the coming years, as you learn more about investing, I would assume that you're probably going to lower this. You're probably going to end up cutting this by probably cutting it in half, or probably reducing it significantly over the coming years. Similar to you, when I first built out my M1 finance portfolio, and that's one of the fun and cons, the pros and cons of M1 is it's so easy to add all of these great companies into your different pies, but you realize after the fact, you're like, do I really need all these companies in my portfolio? Like you, I kind of did the same thing. I added a ton of companies. All right, let's take a look at your setup here. So you got 8 slices, you got your ultra high dividend ETFs, you got your consumer staples, dividend growth ETFs, tech, fintech, energy, healthcare, and real estate. Okay, in my last video last week, I talked about your dividend investing based off of your time horizon. You didn't mention in your email what your time horizon is. So, if you go back to this video over here, right, how to invest based off of your time horizon, this is the question that everyone has to ask themselves. Okay, well, I'm investing. Why am I investing? What is the goal behind what I'm doing here, right? And so that's the very first thing that I would encourage you to make sure you understand is, what is your timeline? When do you plan on living off the dividend income from your portfolio? So because you didn't mention it in the email, I'm going to assume that you have, let's say a 20-year time horizon, right? So with a 20-year time horizon, this dividend yield is actually pretty high, okay? So I'm assuming these are, let's see what you got in here. You got QLD, NUSI, and JEPI. I like all of these covered call ETFs, Dominic, but let me tell you this. If your time horizon is longer than 5 years, these are not the ETFs for you. If you plan on reinvesting the dividend for more than 5 years, QLD and NUSI are going to hurt your portfolio more than it's going to help it. Okay, couple of reasons. The growth with these 2 ETFs, actually with all 3 of them, they're capped. Because they're covered call ETFs, you're not going to get the upside over the long term with these ETFs. And you add on to that, you're going to be taxed every single month. So on an annual basis, you're going to be paying taxes on an annual basis with these ETFs. Okay. Now the tax treatment changes year over year based off of the volatility, but it could either be return of capital or it could be ordinary income. In 2021, this was primarily ordinary income. So you're getting unfavorable tax treatment with these ETFs. Okay. So once again, you didn't tell me your time horizon, but if it's over 5 years, I would either consider taking these entirely out of the portfolio or reducing it down to maybe 4 or 5%. Okay? Let me say that one more time. If your time horizon is longer than 5 years, if it's 20 years, I would consider taking this out entirely. If you're so set that you absolutely want to have these, my recommendation would be to consider lowering these down to about 5%. Okay, so, and that goes for everyone. These covered call ETFs, they serve one purpose. They generate income. Do you need that income today? If the answer is no, then you probably don't need those ETFs. My wife and I, we look to live off of the dividend here in the next 1 to 2 years. Yeah, we want the income. So for us, it makes sense. For you, if you have a time horizon over 5 years, not for you. All right, consumers, what do you got in here? Altria Group, Philip Morris, Kimberly-Clark, Pepsi, Kellogg, okay. You got some Dividend Kings, you got some Aristocrats, Toyota, okay. Unless you drive a Toyota, why do you have Toyota in here? It's not historically known really for its dividend. So maybe that's, I guess, the only question mark that I have here. Why Toyota? Maybe you drive a Toyota Tacoma, maybe. Let's see here. Kellogg, yeah, these are fine. Once again, it comes back to your time horizon. If you have over 20 years, I personally would rather see more Home Depot, more Costco, more McDonald's, more Lowe's, more Walmart. If you have, and you also, this is good. Altria Group is kind of a unicorn. This one's fine. Philip Morris is fine. If you have a short time horizon, then yeah, this is good. Keep Kimberly-Clark up there. If your time horizon is over 15, 20 years, you got to lower this, and because of the compounding growth rate, okay? And you've been watching my channel for a while, so you probably know this, right? It all comes down to your time horizon and the dividend CAGR, the compounded annual growth rate, really important. Industrials, what do you got in here? Texas Instruments, industrials, okay. Lockheed Martin, 3M, Waste Management, Raytheon, Smith & Wesson, nice. Northrop Grumman, Honeywell, General. Okay. These are all really well-established companies and really, really good names. The allocation is fine. I don't really have much to say about this. It's been doing really, really well this year. I think those are fine. Dividend growth ETFs. VYM, VOO, SHD, and GGRO. These are the exact ones, well, except for VOO. But these are all really great. I can't say anything bad about these. I wish I had your time horizon. I could say a little bit more, but these are really good ETFs. Tech and FinTech, VGT, BlackRock, Apple, Ali, okay. Yeah. What I'm looking for here is I'm looking for like speculative FinTechs, or, I'm like, if, for example, you had like Lemonade in here or something, I would be like, okay, well, maybe, there's got to be a reason why you're investing in those. Right? Energy. Okay. Yeah. I personally cannot say anything bad about energy given this exhibit A, because it's done so well. In the long term, I am not bullish on energy. I've been very vocal about that for years. But the market works in cycles, right? Like energy is definitely having a comeback. Healthcare. Johnson & Johnson, CVS, AbbVie, Pfizer. Yeah, these are good. Yeah. Healthcare for real estate. 1% in real estate. Okay, I like these. I like WPC, I like MPW, and I like AMT. You could also look at Industrial REITs. I really like Prologis, ticker symbol PLD. I really like Stag Industrials, ticker STAG. And, but yeah, American Tower is probably one of my, AMT and PLD, Prologis, are my favorite growth REITs. Well, Dominic, thank you so much for sending over your portfolio. There's only two things that I would share that I think you really, really want to make sure that you're addressing or at least revisiting. The first is the number of holdings. I think 54 is a bit high. What I would recommend you do is take a look at every single one of your slices and take a look at each individual company. If you do not know how that company or each company in your portfolio generates revenue, I would consider removing the company. Okay, that's the first thing. And whether you do that today, a year from now, 2 years from now, I think that applies for everyone. If you're going to hold a company in your portfolio, make sure you know how they generate, an individual company, make sure you know how they generate revenue. And then the other thing is this cover call ETF. This slice, I think this is a lost opportunity for you. Okay, unless you plan on retiring in the next 5 years, this is a lost opportunity, and I would 100% revisit your strategy with this slice. But yeah, other than that, the companies in your portfolio are really high quality, really great brands. Thank you so much for sending over your portfolio. All right, the last portfolio is from Andrew. Andrew writes, "Hi Jake, thank you for taking the time to review my portfolio. I'm 43 years old and started investing in 2013, back when I didn't make a lot of money. I make around 40K a year now, which is pretty low considering my age of 43, but I feel like I'm on the right track. One of my goals is to increase my income with either a better job or some sources or other sources of income. Over the past 6 months, my portfolio has changed a lot. I went from 10 consistent stocks up to 20, then down to 7, and then down to 3, all from watching videos of super investors like Li Lu and Charlie Munger discuss concentration of their best ideas. I listed Berkshire Hathaway as a core holding in this portfolio. I just made balancing the sectors easier, and I threw my 2 ETFs in there so I didn't have to make a different category. I also have a 457B Roth through my work with 40 shares of VTSAX. I used to have VEMAX, VSMAX, and VWENAX. I think these are your small caps from Vanguard and others. But recently, I just exchanged them for more VTSAX to make tracking a lot easier and to earn more dividends of VTSAX. Just a side note, my wife works for Charles Schwab, so I'm forced to use them as my broker, and recently found SWPPX, which is the S&P 500 index fund. It has a much higher dividend than VOO and thought your fans might be interested in it. I prefer index funds to ETFs as I'm less likely to sell them. However, for this portfolio, I figured it'd be nice to get VYM and SPYD. Thanks in advance and take care, Andrew." Well, Andrew, thank you so much for sending over your portfolio. I would say you're pretty normal, right? You've changed your mind a few times. I think it's normal. How many people go to college and end up changing the degree halfway through? It's very normal to change your mind. And I don't think you should really feel bad about it. I think you should just kind of understand, okay, why you're doing it and not beat yourself up if you end up changing your mind, because I think it's okay to change your mind. All right, so let's take a look at your portfolio here. So you have in your core holdings, you have 27%. You got consumer staples. I like these little icons over here. That's kind of cool. You got consumer discretionary, information technology, financials, healthcare. Let's take a look at your weighting per, with your individual holdings. So your absolute highest position, your core holding is Berkshire. Berkshire in itself is like an ETF, right? It's pretty much an ETF. Your second largest holdings are at 4%. You got Tesla, you got Microsoft, you got Facebook, Johnson & Johnson, and Bank of America. And so what it looks like you have a balance between growth and value. You have some companies in here that pay dividends, some that don't. You got Waste Management, you got Unity Software, you got Procter & Gamble, Pepsi, NextEra Energy. You got a lot of really high quality companies in here. And so I think one thing that you have to be aware of is when you're investing, you change your mind because either you learn something that you didn't know before, something in your life has changed, or, you're just bored and you're thinking about something new and you get a new idea, right? Of those three, you want to try to avoid the last one. You want to avoid getting bored and just changing things just to change it. And I think that's what happens with a lot of new investors is they are very impressionable. Maybe they watch one video or read one blog or one article and they're like, okay, I need to change my entire strategy. That's something that you want to try to avoid. It's okay to change your mind as things in your life changes. And so trying to limit that. And I think over the long term, the people that are able to stick to a solid strategy over the long term, and I'm talking decades, that's really what's going to generate wealth. And I think really repeatable wealth for your average person. Okay. What I do like is I like in your email that you mentioned that you're looking into more of an index approach, investing more into index funds. And I think that's a really, really good idea. I think one of the most important things is when you're in your mid 40s or early 40s, you have to understand and really reasonably think, okay, when do you plan on living off of your portfolio? When do you plan on tapping into the dividend or the equity in your portfolio? Is it before the age of 59 and a half or is it after? Because you're approaching that age where it's almost just as important to understand which type of account, which brokerage account you're investing in as much as it is, which investments, which companies. So if you know that you plan on retiring after the age of 59 and a half, in most cases, your top priority should be maxing out your retirement accounts, that being your 401k or your 457B or whichever retirement accounts that are available to you. That should be probably in most cases your top priority. And then everything left over could then go into a taxable account, for example. So really, really important. I think with a portfolio like this, the most important thing for me is you understand why you're investing, what's your strategy behind it, especially if you're investing in individual companies. Don't just blindly invest into something just for shits and giggles. I don't know how else to say that. Just make sure that you understand why you're doing it and make sure that you're doing it in the right account type, whether a taxable or a retirement account, and then stick with it, right? You mentioned that you're maybe a lower earner. This is what I personally would recommend. If I was in your shoes, I would try to keep it as simple as humanly possible, right? Pick a few handful of high quality ETFs, maybe a handful of really high quality companies, dollar cost average into them, but then focus on how can you do these three things. How can you stay out of consumer debt? How can you cut your expenses? And how can you make more money? Right? So if you're a low earner, what are things that you could do, right? Could you side hustle? Could you, maybe invest into real estate? Could you move into a home that's a fixer upper? And on your weekends, could you spend time remodeling the bathroom and the kitchen, live in the home for 2 years, and then sell it for a profit, right? Is that something that you could do? Now, obviously, everyone has their own priorities and what they want to do in their free time. But in my opinion, that's what I would be focused on. Because when you think about what's going to move the needle, whether you invest 1% in JP Morgan or 2% in waste management, is not going to really help you retire earlier or happier. Okay. So that's my advice there. When you're thinking about this, think about the big picture, right? Don't get too far in the weeds because you'll drive yourself crazy. And then to your point, what you mentioned earlier, changing your mind, the more you worry about the small little nitty gritty things, the more you're going to be prone to changing your mind. And I share that because I'm right there with you. I experienced the exact same thing. So have the big picture in mind. Understand what brings you happiness with you and your family, and then focus on those things. But yeah, that's just my 2 cents. Andrew, thank you so much for sending over your portfolio. Thank you so much for watching, everybody. I hope that the video was helpful. I hope that you learned something new. And you know what? There's a lot of stuff going on in the world, right? There's a lot of things to be sad about, but there's also a lot of things to be grateful for and to be happy. And you know what? Anytime you get down, just look at some kittens. I don't know what it is about kittens, but they always put a smile on my face. Find that one thing that puts a smile on your face. Look at it. Remind yourself that, you know what? Everything's going to be okay. Thanks for watching. I'll catch everybody in next week's video. We'll see ya.
You know what? I think we're going to be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.